look, I think earnings season is actually going to buoy the market and improve sentiment at the moment, which is just what we need. And look, you've had, 20% of the S&P 500 already reporting Q1 earnings. You're starting to get numbers from Europe as well. And it's really clear that the expectations for revenues and earnings are just too optimistic for Q1. We've got revenue growth of 0.6%. We've got earnings growth of minus 14%. The numbers so far are a little bit better on the revenue side, but much worse on the earnings side. And the focus, as you quite rightly highlighted, Karen, is more on balance sheet strength. It's more about news on dividend policy, suspension of stock buybacks, and guidance for Q2 and beyond. And the key thing here is guidance. Many companies have understandably just suspended their guidance, and lack of guidance leaves estimates just too high for future quarters. You even had examples on Monday with IBM and on Tuesday with Coke. They both reported Q1 numbers, but both pulled their annual guidance. We're kind of more focused on, value and cyclical earnings numbers being revised down perhaps more than growth and defensives. You're certainly seeing some interesting numbers come through in that regard. And of course, you mentioned the Credit Suisse numbers. Almost half of the regional investment banks in the US have reported, and there's a very similar picture. Earnings growth has contracted. I think in the US, we're down about 48%, which is about 18% below expectations. And it's all on the back of outsized loan loss reserves, and that's what everybody's focused on. I guess we're expecting to see a lot more defaults, a lot more delinquencies, so avoid small cap, mid cap. We're expecting to see more M&A activity, but that's through necessity more than anything else. But the key thing here is valuations just remain really high. There are historic levels, particularly in the US, perhaps less so in Europe. Remember, the one thing that has happened historically, corporations have been the largest buyers of equities. And of course, share buybacks are declining to the tune of around 50% year on year. So that's not going to be good. But bottom line here is that everyone's revising their numbers downwards when they can. And obviously, they then end up beating expectations, and that helps boost sentiment. And that's just what we need to see at the moment.